Okay, welcome back to hour 4 of our 4-hour webinar. Thanks for joining us again. So we're on now, we're talking about corporate taxation. We're on M&P and GRR. Manufacturing and processing M&P companies can get a tax credit equal to 13% of their Canadian manufacturing and processing M&P income. However, they can only get this M&P credit on income that doesn't already get the small business deduction. Recall, that's a 19% credit, so that's an even better credit. All companies that earn income that does not already get some special tax treatment like the small business deduction or investment income subject to refundable tax treatment, which we'll discuss soon, or this M&P credit, can get a general rate reduction, a GRR. Essentially, it's like a tax credit equal to 13% of their taxable income. So basically, on any $1 of corporate income, you're going to either get small business deduction, which is wonderful, or if you're a manufacturer, the M&P credit, which is a 13% credit. If you're not a manufacturer, then you'll get the general rate reduction, a 13% credit. So you're going to get sort of one of those three for every dollar of income. So notice how the federal corporate tax rate on income, say above the $500,000 that doesn't get the small business deduction, is 15%. The 38% minus the 10% abatement minus the 13%, say, general rate reduction credit. Or if you're a manufacturer, you get the M&P. You don't get both on the same dollar of income, but example of M&P and GRR. So let's say we have a Canadian-controlled private corporation, a CCPC, earned $1 million of income in 2022. All of the company's income is Canadian active business income, and $400,000 is Canadian M&P income. Well, because they're a CCPC earning active business income, they're going to get the small business deduction, which is a 19% tax credit. But you can only get that on a maximum of $500,000 of income. We're pretending there's no associated companies or anything like that. They're going to get the M&P credit on $400,000 of income. And then they have $100,000 left over. That's going to get the 13% general rate reduction tax credit. Dividends earned by corporations. Well, Canadian dividend income earned by corporations are allowed as a Division C deduction, meaning they're not in taxable income. They're tax-free. Some foreign dividends are also tax-free, but we're not going to talk about foreign affiliate taxation today. But Canadian dividends definitely are allowed as a Division C deduction, so tax-free, at least under Part 1. These dividends, when earned by a private company, are subject to Part 4 tax, which we will be discussing very soon. RDTOH. So the refundable dividend tax on hand, RDTOH accounts, are notional or informational accounts. They only exist for tax, and they basically keep track of refundable taxes, income taxes that a private company has paid and can get back from the federal government. So RDTOH is confusing, but good. It's the amount of money you, private company, can get back from federal government. Only private companies have an RDTOH account. No one else has this. And there are two. There's eligible RDTOH and non-eligible RDTOH. We'll talk about them soon. Eligible is kind of better, but unfortunately, most things go into non-eligible. But I'll explain that soon. The company can get a dividend refund, sort of a refund of the federal tax, when it pays a taxable dividend. And we'll talk about that soon as well. Part 4 tax. The Part 4 tax on Canadian dividends received from non-connected companies is 38 1/3% of the dividend. So if you're a private company getting dividends, you don't pay Part 1 tax, which is good. It's tax-free, sort of, but you do pay Part 4 tax. Only private companies pay Part 4 tax, nobody else. So for example, if a private company received a $100,000 dividend, then it will probably pay $38,333 in Part 4 tax. That probably sounds bad, but here's the good news. Any Part 4 tax paid by the private company will add to that company's RDTOH account. Now, which one? There's two. Well, if the dividends received are eligible dividends, they add to eligible RDTOH. If the dividends received are non-eligible dividends, they add to non-eligible RDTOH. So there's some logic there. Dividends from connected companies. The Part 4 tax on Canadian dividends received from connected companies is usually less. It's never more, it's usually less. It's equal to the parent's ownership percentage. So if I own 100% of the shares, that's 100%. If I own 60% of the shares, that's 60%, times the payer company's dividend refund. So why do I say it's usually less? Well, the payer company might not get a dividend refund. If the dividend refund is zero, then the Part 4 tax the parent company pays is zero. Anything times zero is zero. Two companies are connected, right, if one controls the other, or if one owns more than 10% of the shares of the other. And those shares have to represent both voting rights and fair market value. Dividend refund. A dividend refund is a reduction of federal tax payable. So that's a good thing, right? Reducing your federal tax payable. Private companies get a dividend refund, or can get a dividend refund, when they pay a taxable dividend. It's part of the tax return, the corporate tax return that you fill out each year. The dividend refund equals the lesser of A, 38 1/3% of the taxable dividends B paid. So if I pause there, if you don't pay any taxable dividends, then the lesser of, that will be the lesser of, right? There'll be a zero. And B, the RDTOH balance. And I know there's two, but I'm just saying one for now. So if you have no RDTOH, you never paid any refundable taxes, for example, no dividend refund for you. Only non-eligible dividends paid can lead to a dividend refund from the non-eligible RDTOH account. So the non-eligible RDTOH is not as good as the eligible, because eligible or non-eligible dividends paid can lead to a dividend refund from the eligible RDTOH account. So eligible RDTOH is better, but unfortunately most things go into non-eligible RDTOH. And only private companies have RDTOH. Only private companies can get a dividend refund. Aggregate investment income. CCPCs, so not all private corporations, just Canadian-controlled private corporations that earn investment income must calculate aggregate investment income each year, AII for short. Aggregate investment income is all investment income included in taxable income. So if you think about that for a moment, Canadian dividend income is not included in taxable income because it's allowed as a Division C deduction, so it's not part of AII. Any net capital loss carryover claimed in the year, well, you can only claim it if you had a sufficient taxable capital gain, right? That effectively is like taking that taxable capital gain out of income, so that reduces AII. So what do CCPCs do after calculating aggregate investment income? Well, unfortunately, they must pay an additional refundable tax, ART for short. Too many acronyms today, isn't there? ART equal to 10 2/3%, so 10.666, etc., percent, times aggregate investment income. So that's an extra federal tax they got to pay, which is bad. But here's the good news. 30 2/3% of aggregate investment income, so 30.666% times aggregate investment income, that amount adds to the CCPC's non-eligible RDTOH account. And why is that good? Because they can get that amount back from the federal government as a dividend refund potentially. Let's do an example problem for corporate tax. ZH Inc., ZHI, is a CCPC with a December 31st year end. ZHI operates a retail business and earns investment income. Calculate ZHI's minimum taxable income, federal income taxes payable, and the balance of its RDTUH accounts, its refundable dividend tax on hand accounts, and any dividend refund for its December 31st, 2022 year end. So it's not asking us about provincial tax. Obviously, it has to pay provincial tax too, but it's just asking for federal. ZHI's net, there's no provincial refundable taxes though. Provincial income tax is much simpler than federal. ZHI's net income for tax purposes is $417,000. Its Canadian retailing business income is $300,000. So if I flip to the next slide, property income of $117,000 was earned in the year, consisting of Canadian dividends received from a connected company of $20,000. The connected company dividends were non-eligible, and the payer did not receive a dividend refund. Okay, so not going to be any Part 4 tax there. That's good. Also, Canadian dividends received from non-connected companies of $30,000. Taxable capital gains of $15,000. So this is all the investment income they earned. Interest income on long-term investments of $25,000 and foreign investment income of $27,000. No foreign income tax was paid. If foreign income tax was paid, we'd report the gross amount of income and we'd get a foreign tax credit, but there was none in this case. Next slide. The company has net capital loss carry forward of $10,000 from a prior year. ZHI is not associated with any other companies and has taxable capital of less than $10 million in the prior year. So that means, we're not going to have to share the $500,000 limit. ZHI's adjusted AII is less than $50,000 in the prior year. So the taxable capital is low. The investment income is low. We're going to get the full $500,000 small business deduction. That's what that's saying. The opening balance in the RDTUH accounts are zero, and the company paid non-taxable, non-eligible dividends of $60,000 in the year. So if we flip to the solution, the net income was given, so we didn't actually have to calculate it, as $417,000. We can subtract Division C deductions to calculate taxable income, right? Canadian dividend income, the net capital loss claimed. These are Division C deductions. They lower the taxable income, and it's taxable income that gets multiplied by the tax rates. Federal rate is 38%. They're going to pay provincial tax. We're not talking about that in this question, but so they're going to get the 10% abatement or federal reduction of tax. That's why we have $35,700 in brackets. If I flip to the solution aggregate investment income, taxable capital gains, less the net capital loss carry forward claimed, of course, interest income, foreign investment income, added that all up, that's aggregate investment income, $57,000. Unfortunately, on top of all the normal tax, we got to pay ART, 10 2/3% tax on our aggregate investment income, which is another $6,080. Solution small business deduction. The 19% of the least of the Canadian active business income, $300,000, or the $500,000 annual business limit will be allowed as a small business deduction tax credit. Obviously, $300,000 is less, so that gets multiplied by 19%. They're not a manufacturer, so they're not getting the MNP. Actually, all their income is getting special tax treatment, so there's no general rate reduction in this example with these numbers. So you add up all the taxes owing minus the tax, small business deduction tax credit, and what do you get? Part 1, or sort of normal federal tax owing, $49,040. But we're a private company, right? And we got dividend income from a non-connected company. So we got to pay Part 4 tax on that $30,000 dividend. And the Part 4 tax rate is 38 1/3%. Notice how it's kind of good to be connected because the Part 4 tax is much less. It's zero on the connected company dividends. In this case, it's zero. It's not always zero, but because they didn't get a dividend refund, our share of zero is zero. So the Part 4 tax in total is $11,500. That might sound bad, but here's the good news. We're going to get a dividend refund of $23,000. Notice how that lowers our federal tax owing. So what's our federal tax owing? $37,540. And of course, we'll owe provincial tax too, but we're not calculating that here today. Solution RDTOH. There was no opening balance in the two RDTOH accounts, but the Part 4 tax paid on the eligible dividends adds to our eligible RDTOH account. So we can potentially get that back, which is good. The 30 2/3% times aggregate investment income, that strange number, $17,480, that adds to non-eligible RDTOH. So the dividend refund is the lesser of. It's either whatever's smaller, the RDTOH balances, or in this case, what's smaller is 38 1/3% times the taxable dividends paid. And they were non-eligible dividends. So what does that mean? It means we first have to get a refund from our non-eligible RDTOH. We kind of bring that down to zero. And then the rest comes out of eligible RDTOH. So in total, the dividend refund will be $23,000, which is what we had already said in a previous slide. But it's good to sort of crunch the numbers and make sure. Moving on to a new corporate tax topic, capital dividend account. A capital dividend in tax is a tax-free dividend. Now you have to file an election before you pay this capital dividend, and only a private corporation, nobody else, only a private corporation can pay a tax-free capital dividend, and they can only do this if they have a positive balance in their CDA, their capital dividend account. The CDA, the capital dividend account, it's like an informational account, a notional account. It's just a tax thing. It keeps track of tax-free items earned by a private corporation. Basically, if there was no capital dividend account, the company that earned tax-free things would have to pay those out eventually, say as a dividend, and that they would then be taxable to the individual shareholder receiving the dividend. The capital dividend account allows the company to pay tax-free dividends up to the shareholder. Confusingly, there's no opening and closing balance, right? Tax-free items earned from day one of the company, or January 1, 1972, but that's a long time ago. So let's just say day one of the company till today, the day you're thinking of paying the dividend. You add up all the tax-free items earned essentially, and you sort of calculate the capital dividend account balance from scratch, like from the beginning, every time you want to pay a capital dividend. CDA calculation. The CDA consists of positive balances of each of the following four items. One, this is the most common one, the tax-free portion of capital gains minus the non-allowable portion of capital losses. So let's say the company's been around for only like 15 years or so. The capital gains inclusion rate it's been different if you go back a long time ago, like to the 90s. But in the last 20 years or so, it's been a half. So if you had a capital gain, it's half taxable. If a private company, I should say, had a capital gain, it's half taxable. The tax-free half adds to the private company's capital dividend account balance. What if the private company had lots and lots and lots of capital losses, like way more capital losses than capital gains? Well, this first line can't be negative, right? It could be positive or zero. If it's negative, you just put a zero and go to the second line. The second line I don't think I'll talk too much about because eligible capital property doesn't even exist anymore, but it used to exist, so it could be relevant, for calculating the capital dividend account. Like, for example, goodwill. If you sold goodwill 10 years ago, the rules were different than today, but the gain on sale was half taxable 10 years ago, and the tax-free half added to your capital dividend account, which is similar to what happens today, but not the same. Tax-free life insurance proceeds received. A company might take out a life insurance policy on its key employees where it's the beneficiary. So if the key executive passes away, sadly, obviously that's horrible, but at least financially the company gets some compensation because the insurance company pays them cash. Well, simple, term life insurance is typically received tax-free. So if a private company gets a tax-free life insurance payment, it adds to its capital dividend account balance. And you could have more than one company, right? A company could be a parent of a sub. The sub could pay a capital dividend up to the parent, right? So capital dividends received from other private companies add to our CDA balance if we're a private company ourselves. Any capital dividends, of course, paid reduce the payer company's balance in the CDA account. So let's do an example problem, capital dividend account. Private Co. is a CCPC, so it's private, with a January 31st year end. Private Co. was incorporated in 2018 and had the following transactions. In 2019, it received a capital dividend of $10,000, so that's going to add to our CDA. In 2021, it earned a capital gain of $40,000, so it's half taxable, right? Half tax-free. But it had a capital loss of $60,000, half allowable, half, not allowable. In 2021, it paid a capital dividend of $3,000. How much of a tax-free capital dividend can it pay? Well, if I flip to the solution, the capital dividends received add to the capital dividend balance. The capital dividends paid get subtracted, and that's how we get $7,000. And of course, we have to file the election before we pay a tax-free dividend. But notice how there were more capital losses than capital gains, but we can't put a negative number in this account. It can be a 0 or a positive number. So it's a 0, right? So the capital dividend account balance, what is it? It's $7,000. Moving on to a new topic, paid up capital, or PUC, or PUC. Tax, we say PUC. PUC is the legal stated capital for shares, right? So only shares, of stock, of capital stock, have a PUC. They also have an ACB, but PUC is different. It's often the same, but it could be different, So if someone pays $100 to buy treasury shares from a new company, let's say, and there's no other shares outstanding, well, then those shares would have a PUC of $100, right? ACB would also be $100 in that simple example. But here's the difference. PUC is averaged for each class of shares. So if you have multiple shareholders buying the same class of shares, PUC is calculated at the corporation level, and each shareholder will have the exact same PUC per share. Whereas their ACB will be different because maybe they buy at different times and they each pay different amounts. So their own ACB is different from some other shareholder. But PUC is calculated as an average amongst all the shareholders, at least per class. So everyone has the same PUC per share if they have the same class of shares. And PUC, paid up capital, is good because it can be returned to a taxpayer tax-free. Wind-ups. A wind-up is when a company wants to cease to exist. So it involves a lot of steps, but after selling or transferring assets, paying, or transferring debts, a company could wind up if it wants to, right? It could redeem all of its shares and eventually file for articles of dissolution and disappear. So I just said redemption of shares, so let's talk about what that is, right? A redemption of shares is when a private company buys back its own shares. And for tax purposes, this leads to a complicated two-step calculation, not just the one-step capital gain or capital loss that we're more familiar with when you sell shares. So if a public company buys back its own shares, which they do all the time, don't they? That's typically just capital gain or capital loss. If you sell your private company shares to somebody else, that's just capital gain or capital loss. But if the private company buys back its own shares, you have step 1, deemed dividend, and step 2, a capital gain or capital loss to calculate. So deemed dividend. The deemed dividend, which is sort of step one, will equal the proceeds of disposition that you get from that private company minus the PUC of your shares. So if I pause there for a moment, PUC is good. It's often a low number, unfortunately, but if it was a big number, you get the PUC back tax-free, and you only pay tax on the deemed dividend on the amount received above the paid-up capital. And when I say deemed dividend, if you haven't heard that term before, think of it as a dividend, right? Because a deemed dividend is taxed exactly the same as a regular dividend. It's grossed up. If it's received by an individual, it's eligible for a dividend tax credit, etc. The company's deemed to pay the deemed dividend, so they can get a dividend refund. It's exactly the same as a dividend, except maybe you didn't get cash or something. So it may not legally be the same as a dividend, but for tax purposes, it's treated exactly the same as a cash dividend. Capital gain or loss. A capital gain or capital loss, this is step 2, has to be calculated because the shareholder is selling his or her shares. They're just selling them back to that same corporation, right? And the company will then cancel the shares. Adjusted proceeds of disposition are used to calculate the capital gain or loss on sale. And that might sound confusing, but it's a good thing. The government essentially allows any amount being taxed as a deemed dividend to be subtracted when you calculate the capital gain so that the same amount is not taxed twice, right? You're only getting the proceeds once if you sell your shares back to the company. You're not getting the proceeds twice, but yet you got to calculate both a deemed dividend and a capital gain, so it would be completely unfair to pay tax twice on the same income that you're getting once. So adjusted proceeds of disposition, which is what you use to calculate your capital gain or loss when there's a redemption of shares, what is that? It's the proceeds minus the deemed dividend that we just talked about in step 1. Section 22, accounts receivable. So we're going to do an example problem real soon. I just want to mention one more topic first, right? Section 22, accounts receivable. This is an election found in Section 22 of the Act that you are allowed to use if you sell accounts receivable. But you can only use this if all or substantially all of the business assets are being sold and the purchaser is going to carry on that business. And all or substantially all, according to the Canada Revenue Agency, means 90% or more. So Section 22 is good, right? Why is it good? It allows, if you think about accounts receivable, they normally go down in value, right? They don't go up in value. So there's probably going to be a loss if you choose to sell them. I mean, you don't have to sell them, but if you choose to sell them, there's a decent chance there'll be a loss on sale. Section 22 allows the seller to claim a business loss on sale instead of a capital loss, and it allows the buyer to claim a reserve for the bad debts. So if I go to the next slide, without Section 22, the seller would typically have a half allowable capital loss on the sale. So that's why Section 22 is good. Both parties must sign the election form. It's a joint election like seller and buyer for it to apply. And here's the bad news. Section 22 requires the purchaser, the buyer, to include the business loss that the seller gets to claim. The buyer has to include that in, his or her, or its if it's a company, but let's just say his or her income in the year of purchase. So this is the one bad thing about Section 22. But I mean, if you don't want to use it, you don't have to. It's often good to use it though, because even the purchaser who has to include this amount in their income, they can now turn around and claim an allowance for bad debts, right? A reserve, which might be equal to or could be even more than this income inclusion. Now we're ready for an example problem on a wind-up. This is a more advanced topic, and it covers a lot of corporate tax topics in one place. So that's why I like this example problem. Your client, Tanya, owns all the shares of T Inc., TI for short. TI is a CCPC, so it's a private company, that carries on an active business in Canada. Tanya's shares have an adjusted cost base and paid up capital, ACB PUC, of $5,000. So they don't have to be the same number, but in this case they are. They often are. Tanya is considering having TI sell all its assets to a purchaser who will continue the business and winding up. If you just look at the picture for a moment, the thing I like about this picture is it reminds you that there's two taxpayers, Tanya and the company, right? The company will pay tax when it sells its assets, and Tanya will pay tax when she sells her shares, back to the company, which is a redemption of shares. So if I flip to the next slide, TI has the following assets: accounts receivable, notice how they've gone down in value; marketable securities, they've gone up in value; inventory, it's gone up in value; and computer equipment, which has also gone up in value, right? I know we originally bought it for 90, but we took depreciation on the equipment. It's now on our books at 50 from a tax perspective, and it's worth 60, so it's gone up in value. TI has unrecorded goodwill with a fair market value of $500,000. That's our biggest asset. Don't forget about goodwill, right? Intangibles are often the huge asset. It could be the biggest asset of your business. It may not show up on your balance sheet because it's internally generated, but don't forget about it. Next slide. TI has accounts payable of $75,000, long-term debt payable of $100,000. TI has a balance in its capital dividend account of $10,000. I know I said there's no opening and closing balances, but let's just go with that. And a balance in its non-eligible RDTUH account of $5,000 immediately prior to selling any assets. TI is not associated with any other, long question. TI is not associated with any other companies. Okay, that's good. That means we can get the full $500,000 business limit. Assume that TI has no taxable income prior to the wind up. If it did, it'd have to pay tax on that income as well, right? And no reserve for doubtful accounts receivable was claimed in the prior year. Okay. If it was, we'd have to add it back to income, but okay, it wasn't. Assume that TI pays tax at a 12% rate. So that's federal and provincial. Finally, we're bringing in provincial tax on active business income, and pays tax at a 50.67% rate on investment income. So notice how investment income earned by a CCPC is taxed at a much, much higher rate, right, than active business income. And again, that's federal and provincial rate added together. Well, if I flip to the solution, just look at one row at a time, and we'll start with opening balances. Don't look at any other row. And just look at one column at a time. If you look near the right of the page, you see CDA opening balance 10,000, non-eligible RD2H opening balance 5,000. Those are we're just keeping track of important information, and this chart is a nice way to do that, right? We had a capital dividend account balance from other stuff, and we're just keeping track of that. We had non-eligible RD2H from prior years. We're just keeping track of that opening balance. What are we going to do? The company wants to wind up, right? So it's going to sell each asset that it owns for fair market value. So now I'm on the second line, right? It says AR. We're going to sell it for fair market value of $140,000. You could also call this second column cash, because everyone likes cash, right? I just call it FMV for fair market value, but you could call it cash. Company's going to get $140,000 of cash selling the accounts receivable, and there's going to be a business loss on sale of $15,000. How do we know it's a business loss? Well, we're going to file the Section 22 election, right? Because we're selling all of our business assets. Our purchaser is continuing on the business, so we're allowed to. That makes this loss a business loss and not a capital loss. And we have two columns for income, not just one. We have the active business income column, and we have the investment income column. And the reason for that is very different tax rates on business income, right? Because we get the small business deduction. Very different tax rates on investment income, where you don't get the small business deduction and you got to pay like additional refundable tax, etc. That's why it's so much higher. Another line, marketable securities, right? We're going to sell that for fair market value of $180,000. So that's why we have $180,000 going in the cash column or the fair market value column. That's how much the company will get selling the marketable securities. There's going to be a capital gain of $80,000 triggered, half taxable. That's why I'm dividing the capital gain by 2. The taxable capital gain, $40,000, is investment income, goes in the investment income column, right? Because it's subject to a different tax rate than business income. And the tax-free half, also $40,000, adds to our capital dividend account balance. That's why if you look in the CDA column, you see $40,000 going into there as well. Inventory is worth $300,000, so we're going to sell it for $300,000. We're going to trigger business income of $30,000 on the sale. That's why it's going in the active business income column. So if I flip to the next slide, computer equipment, that's worth $60,000. So we're going to sell it for $60,000 cash. And that's going to trigger recapture or active business income of $10,000 on the sale. Goodwill, don't forget about goodwill, right? We're selling our business. We're selling the goodwill that goes along with it, right? It's worth $500,000. So we're going to get $500,000 of cash. The gain on sale, $500,000, is a capital gain, half taxable. The taxable capital gain is $250,000. It goes in the investment income column. The tax-free half goes in the capital dividend account, the CDA column. Of course, you got to pay your debts. We all know that. So that's why we have the liabilities. That's like cash coming out of the company. Before we can wind up, we got to pay our debts. So that's why that's now cash coming out. That's why it's a bracket, $75,000, a bracket, $100,000. Cash out of the company. Income taxes payable, don't forget about that. We're going to add up the total active business income and get $25,000. We're going to add up the total investment income and get $290,000 and pay tax at the appropriate tax rates on that income. So if I flip to the next slide, it says solution funds available. The tax liability is a liability that must be paid. And if we add up the two numbers we just calculated, that's why it's a bracket or cash coming out of the company of $149,943. RDTOH. Remember we talked about this briefly. 30 2/3% of your aggregate investment income, which is $290,000, adds to the non-eligible RDTOH. So that's why we have this strange number, $88,933, adding to this private company's non-eligible RDTOH account. And there was an opening balance of $5,000. So we add up the total non-eligible RDTOH and we get $93,000 and something dollars. We add up the total CDA account and we'll use that number later, but we get $300,000. Dividend refund. If you look in the fair market value column, or cash column if you like to call it that, this is a refund of federal tax that this private company can get back. Now it's a bit of an assumption, like we don't know if they're going to pay a big enough taxable dividend, but let's assume they will. They're going to get this $93,933 of non-eligible RDTOH back. So it's kind of like cash coming into the company. It is cash coming into the company eventually. So if you add up all the cash coming in the fair market value column, and you subtract all the taxes and liabilities going out, you get total amount of cash or funds available for distribution of $948,990. So solution distribution of funds, if TI did not want to wind up, I should say, it could just keep the cash, and invest in something else. But the question says they want to wind up. So TI should file an election to pay a tax-free capital dividend of $300,000 to Tanya. That's why we kept track of that column in the big chart, right? How much cash would be left over? It'd be the $948,990 minus the tax-free capital dividend of $300,000. We'd have just under $650,000 of cash left to pay to Tanya on the share redemption. Because don't forget, if there's a redemption of shares, the money that's left over gets paid up to the shareholder, Tanya, and she sells her shares back to the company. And she's going to pay tax on a deemed dividend, which we're going to talk about right now. So solution, redemption of shares, step one. Well, step one is the deemed dividend. The just under $650,000 that's paid to Tanya, she's going to get the deemed dividend back tax-free, and the excess, the $643,990, will be taxed as a dividend to her. Now we can check. Were we right to assume that she's going to get all the RD2H back? The company is going to get all the RD2H back as a dividend refund. Well, let's check. The lesser of the non-eligible RD2H balance, which we calculated earlier as $93,933, and some weird number, 38 1/3% times the taxable dividends paid, the non-eligible dividends paid, which we literally just crunched now, like 643,000. That's much bigger. So what's the lesser of? 93,933. That's going to be the dividend refund. That's what we already assumed, but we were correct to assume it. It was just good to double check. Solution, redemption of shares, step 1. This big problem is almost done. Step 2 is the capital gain or capital loss. Tanya is selling her shares back to the company. The company's going to wind up. It's going to disappear. But before it does that, she's selling her shares and getting the money out, right? Government's not so mean to tax her twice on the same money that she's only getting once. So she can subtract the deemed dividend that we just calculated from her proceeds of disposition to get what we call adjusted proceeds of disposition, which is now $5,000. And we subtract her ACB, which is $5,000. And what's her capital gain on sale or capital loss? 0. No capital gain, no capital loss. Moving on. New topic, Section 85 rollover. You'll notice that we're getting into a lot of complicated tax topics now, and so the level of detail is going to be a little bit lower, right? I just want to introduce some of these topics today. So the Section 85 rollover, this is an election, meaning it's optional, right? You don't have to use it, but it allows a taxpayer to sell eligible property to a Canadian company without triggering any income or capital gains. So that's a good thing, right? Selling things tax-free to a Canadian company. Why pay tax if you don't have to? Eligible property includes lots of things. It includes capital property, which includes depreciable property, goodwill, inventory, excluding real property inventory. So if you're a housing developer and you sell inventory of land or houses or buildings, that's not eligible property. But all other land and building is, right? Next slide. The seller must take back share consideration from that Canadian company to use Section 85. So if you're looking at my picture at the bottom, you see how I have the taxpayer with an arrow going from taxpayer to the rectangle to the company? You got to take back shares to use. You got to take back at least one share. That counts to use Section 85. Non-share consideration, which we call boot, can also be taken. It doesn't have to be, but it can be taken if you want. That could be cash, could be accounts receivable, could be assumed debt, lots of things, anything other than shares, right? Both the seller, taxpayer, and the buyer, the Canadian company, must sign the election form for Section 85 to apply. And the joint election specifies the elected amount. But basically, I want to mention Section 85 doesn't change the business transaction. It just affects the tax consequences. So the business transaction might be, if I'm the taxpayer, I'm selling land to this Canadian company for shares. And I'm using Section 85, so the sale is tax-free. Elected amount limits. The elected amount, there's a few rules. The elected amount, there's a lot of rules. The elected amount cannot be less than tax cost of the asset being sold, which typically means ACB, but if it's a depreciable asset, it probably means UCC, right? That's the minimum you could choose. The elected amount cannot be more than fair market value of the asset being sold. It could be any number between those two numbers, including the two endpoints. Section 85 tax consequences. So Section 85 doesn't change the business transaction. It changes the tax consequences of the transaction. The elected amount that you choose, if you decide to use Section 85, that is, because it's optional, you don't have to use it. But the elected amount, if you choose to use it, determines the proceeds of disposition to the seller. So what does that mean? It means you probably want to pick a low elected amount so that you eliminate any income or capital gain on the transfer. But maybe you want a specific amount of income or capital gains, right? Maybe you have capital losses carried forward, you want to use them up. Or, for example, if QSBC shares are being sold, so qualified small business corporation shares are being sold, you might want to use your capital gains exemption. You might want to get a capital gain of exactly $913,630 if it's 2022, right, when you're doing your transaction. So you can use Section 85 potentially and pick an elected amount that gives you the exact capital gain that you want. That's a benefit of using Section 85. Elected amount. The elected amount also determines, for tax purposes, the tax cost to the purchaser. So, for example, if the Canadian company is buying, as an example, I said ACB of new shares. So if the Canadian company is buying shares, then what's the ACB of those shares for the Canadian company? Well, it's the elected amount, right? Because the elected amount helps determine tax cost to the purchaser. The tax cost of consideration taken back by the seller, well, that's going to equal in total the elected amount. But what if instead of taking just shares, you take shares and boot? Boot might just be cash. Well, the elected amount is first allocated to become ACB of the boot. Maybe it's cash. And whatever's left over, elected amount minus boot, that's going to be the ACB of your new shares. But what if you take back two classes of new shares, common and preferred? Well, the ACB that's left over first gets allocated to the preferred shares, and then only if an amount is left over, and there might not be, will that become ACB of the new common shares that are issued. I'm going to show you an example, but I want to say a few more things first before I show you an example. I know this is a little bit tricky. You can have shares, though, with an ACB of 0, right? It's not ideal, but it happens all the time. Just means you'll pay more tax when you sell those shares, right? Because you'll have a bigger capital gain on sale. Another thing the elected amount determines is the PUC, the paid up capital of the new share or shares that the seller is taken back. Because you got to take back new shares to use Section 85. What's the PUC of those shares? Well, there's a big formula that we're not going to get into, but if I simplify it, the PUC of those new shares will typically equal elected amount minus boot. Let's do an example. Example problem, Section 85. Your client, Mr. T, wants to incorporate his sole proprietorship. The following 3 assets will be sold to T Inc. using Section 85 in return for $150,000 of debt receivable, boot, right? And $450,000 of new preferred shares. He doesn't have to take those 2 things back. Like, he has to take back shares. He doesn't have to take boot, and he could even take more than $150,000 of boot, but let's just go with this. He's selling 3 things: equipment. Notice how it's gone up in value, right, compared to the UCC. Inventory and goodwill, internally generated. So it's not on the books, but it's worth $200,000. Don't forget about goodwill, right? So if I flip to the solution, look at this one row at a time. Equipment is worth $100,000, tax value $70,000. We could pick any elected amount we want, but he doesn't want to pay tax. So if you don't want to pay tax, you pick the lowest possible elected amount of $70,000. And you'll see soon that will trigger no income. You can take boot, debt receivable of $70,000 without triggering negative tax consequences. You have to transact a fair market value, though, to avoid negative tax consequences. So if you're taking $70,000 of debt and you're selling equipment worth $100,000, you better take $30,000 worth of preferred shares. And you can make the shares redeemable and retractable to sort of fix their value at $30,000. Notice how 70 plus 30 adds up to 100. That's equal to the fair market value of the equipment being sold. So are we transacting a fair market value? Yes. Good. Now you look at the inventory line. So just look at the row that says inventory. That's worth $300 on our tax books at $150. We could pick any elected amount we want, but we don't want to pay tax, so let's pick $150, the minimum possible elected amount. We could take more debt. We could take debt of 150,000, but for whatever reason, the business transaction your client wanted, Mr. T wanted 150,000 in total of debt. So if he's taking 70 on the equipment, he can only take 80,000 on the inventory so that it adds up to what he wanted, 150,000. And I just made up these numbers. I'm not saying this is optimal. Like normally you take the most boot you can, but let's just go with these numbers and see what happens. He's got to take preferred shares, right, to use Section 85. The inventory is worth 300. So if he's taking 80,000 of debt receivable from the new company, he's got to take 220,000 of new preferred shares so that he's transacting at fair market value. Now we look at goodwill, and only goodwill, right? It's worth 200. It's on the books at 0 because it's internally generated. You might be thinking, let's pick 0 as the elected amount, but 0, legally speaking, is not an amount. So we can't sell it for 0. We could sell it for $1. So just pick $1. And we could take $1 of debt, but usually you don't. And anyways, he's already at 150,000 of total debt receivable. So we'll put 0 debt. How much preferred shares should he get when he sells the goodwill? 200,000. Why? Because the goodwill's worth 200,000 and we got to transact at fair market value. So if you add up these final 3 columns, you get a total elected amount of $220,001, total boot debt receivable of 150,000, and total new preferred shares being issued of $450,000. So if I flip to the solution, Mr. T's tax consequences, this is kind of the main reason we're using Section 85. Yes, Mr. T has to report his sale of these 3 assets on his tax return, but by using Section 85, he reports them at proceeds of disposition equal to, not fair market value, the elected amount. And what happens for the equipment? No recapture. What happens for the inventory? No business income triggered. What happens for the goodwill? Okay, for the goodwill, there's a tiny $1 capital gain triggered 50-cent taxable capital gain. And that's just because it was on the books at 0 and we can't pick 0 as an elected amount, so we picked $1. But he will pay a tiny, a few pennies of tax. And we do have to report this, even though it's a small number. There's no such thing as materiality in tax, isn't there? Even though it's 50 cents, we got to report it on his tax return. Very important. Solution cost of consideration. Mr. T is getting boot debt receivable, and it will have an ACB of 150,000. He's getting preferred shares worth 450. The ACB and PUC of his new shares will equal elected amount minus boot. We could have taken more boot, but we didn't. So the elected amount, this is from the chart we read earlier, is $220,001, and the boot is 150,000. So his new shares will have an ACB and PUC of $70,001, just because of the amount of boot we took. Solution tax attributes for T Inc. The company T Inc. is getting inventory. So what's the UCC? 70,000. What's the ACB? It actually stays the same as it was for the original shareholder at 105. That's a little bit confusing. I don't want to get into too many details on this. I know it's tricky. Inventory. This is an advanced topic though. Inventory is acquired at the elected amount. So the company has the inventory. Its cost is 150. Goodwill is acquired at the elected amount. Let's just say it's $1. Technically it's 50 cents, but I don't want to get into that non-arm's length restriction that will lower it from $1 to 50 cents. Either way, it's really low. So that's what I wanted to cover though, just the basics on Section 85. Other rollovers. Other rollovers exist, and we're just going to talk about them very, very briefly. No details. A rollover is good in tax. When I say rollover, I mean a tax-free sale, right? An automatic rollover means no election form needs to be filed. Section 85 is different. It's not automatic. You had to fill out a form to file the election if you wanted to use it. So if you want Section 85 to take precedence over these automatic rollovers, no problem, fill out the form and file it on time, right? It's due basically with your tax return deadline. So if an automatic rollover applies, basically the sale is tax-free and the tax attributes kind of move from the old asset to the new asset. So examples of other rollovers. So convertible securities. Maybe you have convertible bonds that you want to convert into shares. So there's only one company here. Again, I'm not going to get into the details, but this can be done typically on a tax-free basis. Share capital reorganization. This is when you sort of change the share structure of your company. If you meet certain conditions, it can be done on a tax-free basis, right? Maybe you had one class of shares, you want two, so you can pay different dividend amounts to different shareholders. Well, one way to accomplish that is to do a share capital reorganization, and as long as you meet certain conditions, it can be tax-free. Arm's length share for share exchange, another complex topic, right? This is when you have your client sell shares of one company, company A, to another company, company B, but not selling for cash, selling for more shares. That's what we mean by share for share exchange. And if it's truly an arm's length share for share exchange, and you meet a few conditions, a certain section of the Act 85.1 applies, which is not the same as, confusingly, as Section 85, and it allows this transaction to be tax-free. Amalgamation, so new topic. Again, we're just going to introduce these complex topics. An amalgamation is when two or more companies legally become one. The old companies disappear and a new company is formed. So maybe it's parent and sub, like the picture on the left, or maybe it's two sister companies. Either way, they amalgamate and become one, and they disappear, and a new company is formed. Amalgamations and tax consequences. The amalgamation triggers deemed year ends in the predecessor companies, the companies that are now gone. A new company is formed. It picks a new year end, right? And here's the main tax point. Those assets and liabilities and any tax losses just flow at tax cost to the new amalgamated company. So it's a tax-free transaction. Wind up of a subsidiary. A wind up of a 90% owned subsidiary or more, like 100% owned, into its parent is typically a tax-free rollover. All the assets, tax losses, liabilities can just flow on up completely tax-free. So just to give one advanced tax point, if you have a parent and sub and one is profitable and one has losses, consider either amalgamating them, which is often easier, or winding up the sub into the parent, and then those losses kind of flow on up and can be used by the parent. Vertical amalgamation, another complex topic we're just going to introduce. If you have an amalgamation of 100% owned parent and sub, so that's kind of the picture on the left, or a wind up of a 90% or more owned sub into the parent, that's the picture on the right, then there's a certain paragraph of the Act that I don't want to get into today, but 88(1)D, which allows you to increase ACB of certain non-depreciable capital property, like say land, marketable securities, that was previously owned by the subsidiary. And why is that good? Well, more ACB means, and we're not going to get into the formula or anything, but more ACB means less tax to pay in the future. Acquisition of control, another complex topic. We're just going to introduce it. Complex acquisition of control, or AOC rules, apply if more than 50% of the voting shares are purchased from an arm's length person. So arm's length means like someone you're not related to, right? Buying shares from a related person does not lead to an AOC. You still bought the shares, but there's no tax consequences. If there's an AOC, an acquisition of control, one of the main things that happen, and the only one we'll talk about, is the tax losses disappear. An amalgamation or windup, though, I just wanted to mention this, is typically not an acquisition of control. They're typically completely separate topics. You could have both, but often it's just one or the other. It depends on the facts. Okay, final few topics. General Anti-Avoidance Rule, GAAR, or GAR for short. The General Anti-Avoidance Rule, or GAR, if it applies, it stops the tax benefit from your tax plan from working. It denies the tax benefit. So GAR is very serious, right? You have to think about it when you're doing tax planning. GAR can apply if a transaction or series of transactions is done mainly just to get a tax benefit, so that's called an avoidance transaction, and is a misuse or abuse of the act. GAR does not apply to transactions done primarily for business reasons or primarily for estate planning reasons, for example. So you're allowed to run your business or manage your assets as you see fit. GAR is not meant to stop you from making smart business decisions. But if you're truly doing something not for business reasons but for tax planning reasons, and what you're doing is abusive, then that's when GAR applies, and that's bad because it stops your tax plan from working. If your tax plan is not abusive or and does not misuse the act, then as long as it's legal, great, no problem. So GAR and tax planning. Tax planning is allowed and is recommended as long as it is legal, right? Following all the tax laws, reporting all the income, filing all your tax returns on time, and as long as it is not abusive. Now, it's not always obvious to know the difference, what's abusive, what's not, but you kind of have to use your judgment. The Canada Revenue Agency has stated they're not going to apply GAR to sort of typical tax planning situations that everybody does, like purifying a company to get the capital gains exemption. That's something we covered today. Using Section 85 to incorporate your sole proprietorship on a tax-free rollover basis. That's something we covered today. Basic estate planning is also allowed. We didn't really have time for that today. So basically, you have to use your judgment. Does the tax plan seem too good to be true? Does it seem abusive, using your professional judgment? If so, probably stay away from it. It's probably too risky, right? Final slide of the day. Reporting avoidance transactions. Certain avoidance transactions, remember, avoidance transaction is one done not for business reasons, but mainly just to save tax. So certain avoidance transactions must be reported to the CRA by filling out a certain form, a reportable transaction information return, they call it. And the form is due June 30th of the following year, or at least it was. The 2021 federal budget has changed this starting in 2022. So starting in 2022, this form is due 45 days after the transaction. And there's penalties, right, if you don't file your tax forms on time. So that's why it's important to know about this. But reporting the avoidance transaction on this form, it does not in any way mean that GAR will apply. So it doesn't stop any tax planning. It's just more work for the finance team, right? More work for you, basically. That is what I wanted to cover today. I want to thank you very much for attending this webinar. I hope that you enjoyed this webinar, and I wish you all the best of luck. So thank you so much.